Today on the Money Mindset Mastery podcast, the focus is on a seldom discussed yet critical topic, the psychology behind hoarding cash. Hosts Jim and Ryan delve into why many feel the need to stash away more money than necessary. They explore common reasons such as the fear of loss, the illusion of safety, and a lack of financial literacy. The importance of distinguishing between saving and investing is emphasized, highlighting the potential downsides of keeping funds in savings accounts or GICs in the face of inflation. The episode challenges popular financial myths, underscores the necessity of personalized financial advice over generic bank suggestions, and introduces dollar cost averaging as a strategic approach to investment. Ultimately, Jim and Ryan advocate for the value of consulting trusted advisors to maintain and adjust financial goals effectively. They aim to equip listeners with the knowledge to navigate their financial journey confidently.
Welcome to the Money Mindset Mastery podcast with your host Jim and Ryan. Tune in now, get ready to dive in. Unlock the secrets and your dreams take a leap. Money Mindset Mastery, it's time to shine.
I love that tune. Ryan, I thought I saw you on the way to getting your
Picking up dance moves already.
Well, let's invite or welcome everyone to the Money Mindset Mastery podcast. I'm your host, Jim, or joining me today is my one partner in crime, Ryan Janot.
Yes.
Ryan, aside from the dancing, how you doing?
I'm doing great. Beautiful day. Hopefully the spring is finally here. So
Yeah, good. And we also have our, should we say, co-host? How is that? How should we co what?
Co-worker.
Co-worker. All right. Well, we have Denis Bizon, our co-worker and co-host as well of our episode today, and we're going to talk about something that kind of been irritating me, to be honest with you. And that is, people who are sitting on the sidelines with a bunch of money in savings accounts. And we want to talk about the impact of hoarding that cash and what the impact is on retirement planning. Mm-hmm. So we all have different experiences in working with clients, and we're just going to kind of work on our way through this episode. But before we get started, if you like what you hear, we ask you to just like and share and do whatever. And we try to bring a lot of hopefully valuable information to our listeners and our viewers. So we'd encourage you to like and share our episodes. I think we're going to start off with the psychology behind hoarding cash and some of the reasons why people might prefer to hold on to cash, including fear of loss, lack of financial literacy, and the illusion of safety. And Denis, I might even just start off with you because you are the portfolio manager at TVH Wealth. You've been doing this for a long time. I'm sure you've seen this in the past. It seems to be cyclical in nature. In your experience, why do you think people tend to hoard cash and sit on the sidelines?
Well, there's a couple of reasons, depending if that cash was in the market. And if it was, and they went to cash at a certain point because they were scared the markets are going to crash, they're going to lose money. Even if they're not going to use it like within the next couple of years where it's for retirement, the fear of going back in the market, they try to time the market, and that is hard to do, if not impossible, and they just stay in cash. What usually happens when they stay in cash, they miss the rebound, they miss the positive, and then it becomes, it's almost like people get frozen, which is why I always, unless you have a short-term horizon for the money, where it should be in cash, 3 to 6 months, you're going to use it all to spend it on, buy a car, go for a vacation. I tend to tell people not to go to cash if the markets are volatile, but to really stay with it and keep an eye on it. The world, these scenarios, even during COVID, that the world's going to end, it usually doesn't, and we haven't seen it yet. And it does bounce back. So anybody who went to cash during the COVID time missed that big bounce back, both in the fixed income market and the equity market, and they end up frozen afterwards. And, there's always a reason to sell, and some people never find a reason to buy, and they just stay in cash.
Yeah, I'm going to use 2008 as a perfect example. I had, 2008, the global financial markets, it was in a disarray, like lots of volatility. There were failures out there. The markets, one day they'd be up 1,000 points, another day they'd be down 1,000 points. Like it was a scary time. Many people lost well over 45% plus of their portfolio values. And it was very difficult to navigate people through that situation because it was legitimately scary. It was very difficult to say to them, this is the right decision. And I remember one of the investment companies that I used back then provided me with a piece, and they used an example of 1973-74. So 1973-74, similar extreme market correction, close to 50% over that 2-year period. And they looked at, and again, this is hindsight all the time, right? Looking back, the impact of different decisions. So they looked at someone who invested $10,000 as the first example. Their portfolio dropped by $5,500, so 55%. They had $4,500, and the impact 20 years later of doing nothing, just staying fully invested. The first scenario was the decision of getting out of the market. That was the first decision. And the impact of that decision and investing that money in GICs for the next 20 years or so. And we're talking about mid-'80s too, when GICs were really providing a significant rate of return.
Yeah.
And I think that person 20 years later had a portfolio of about $100,000. And then the second option was pulling out of the market, sitting in cash for 12 months, and then redeploying that capital back into the markets. That person fared a little bit better. I believe it was like 150 to 175,000 after 20 years. The third option was the one that I mentioned, was do nothing. And I believe that investor ended up with about $250,000 after 20 years. And then the fourth option was take another $10,000. So you're dealing with your loss, stay in the market. The dollar cost average $10,000 over a 12-month period. That person ended up with about $500,000 20 years later. And the final one, which is the difficult one, was to take an extra $10,000, invest it at the absolute bottom of the market, which again is very difficult to predict. That person ended up with close to $750,000 20 years later. And the point that I'm trying to make is people do tend to retreat. So that's why they're holding on to cash. They're afraid. To your point, Denis, they're afraid that they're going to lose it all. It's the end of the world. And if we kind of use recency bias, I think COVID has driven some of that as well, right? Ryan, do you want to maybe speak to that? How COVID, shifted some of the change and the thought process with people holding on to money?
Well, yeah, I think it speaks to the psychology of people and really their deep-seated need to have security and control over the money, right? And what happened through COVID is this uncertainty that happened. So for people to feel safe, they tucked it in their mattresses and put it away. And this hoarding became quite common throughout, especially the COVID time. So, whether it's financial or it's like their own personal thing, that's where the behavior just continued to reinforce itself. And I think, it can really lead to a lot of missed opportunities, as you just kind of pointed out, is, their ability to keep up with inflation. Obviously, that's one of the biggest things we're facing right now. And really the long-term effects. And as we're talking about retirement for a lot of people, their inability to keep up with inflation and the growing costs, it's what can we do to get money working for you instead of just tucking it away. And it's really difficult for a lot of people to overcome. And, the psychology behind it, the psychology of money, and talking with a lot of clients is really understanding what their motivation is behind understanding these deep-seated need to hold on to the cash, and why, holding on to the cash or holding it in GICs can really affect their really longer-term growth. And and really understanding like what is the anxiety that happens with people when it comes to this, right? And I think when you talk to professionals like ourselves, and seeking a little bit of advice, we can help clarify some of those deep-seated routes, and make sure that, for us, we tend to set goals for people and help them set their own goals of what it is that they want. And again, we've said this in every one of our podcasts, hence why we host a podcast, is education. We want people to be truly educated in the money. And we want you to be educated because, whether it's the system or education or whatever, there's a lot of misinformation or no information, proper information at all. So I think also one of the things is just encouraging people to take some small steps towards that. Seek the professional advice of people that you trust, and not simply a TikTok video. Not to say I won't be doing some TikTok dances here and there, but to seek people that you can trust. And for us, TVH Financial TVH Group, there's a group of professionals that are working together. So education becomes a big key, and I'll say that over and over again. But when it comes to hiding your cash, there's a lot of missed opportunities that I see with clients that really can be unraveled with education, talking to the right people. And when you have people like us that really care about helping people achieve their goals and their longer term, then the anxiety seems to just kind of go away, and new behaviors are created. So anyway, I hope that.
So Denis, let's educate people. Let's talk about the impact of keeping your money in a GIC, for example, or daily interest savings accounts, and the impact that has in comparing to inflation, right? Because a lot of people don't understand that, they could lock into a GIC for 5 years at, call it 3%. But if they're doing that, they're not going to necessarily keep up with inflation long term, specifically because we don't know what those rates are going to be, the renewal rates are going to be 5 years from now. So can you maybe speak on the impact of putting your money into cash and GICs compared to long-term keeping up with inflation?
Yeah, when you say cash, especially at the bank accounts where some people may have 20,000 in there and still only getting 0.5 interest rate. That's, sometimes they don't see how much they're getting paid. A little education on that is always good for the client. And Ryan, I think you hit the point. And when you trust somebody, you got to find an advisor you trust where they explain to you what's going on, the effect that your $2 today or your $20 today is not going to buy the same thing 5 years from now. If the inflation was high like we had the last couple of years, you're going to get even less purchasing power. So just putting that in, speaking to somebody that you trust, telling what's going on in the markets. And when those things actually come to fruition, they start trusting. They go, okay, I'm starting to understand a little more. So it's also looking at what's going on around you and speaking to your advisor, trying to get the education from them. And then they start seeing it for themselves. And that's when the trust starts. And that's when they say, oh, my $20 won't be worth that much. And adding, because inflation could have changed, if it's 2% per year, you look at that. And if they're only getting part of that, even investing, it's not going to give it. And cash or a GIC is not going to get them where they want to be. It'll actually be down, theoretically, or in fact, because they're going to be not keeping up with inflation. So that's not growing your investments. It's growing your investments, but not even enough to keep up to what you can buy today with it. So that's why it's good to speak to someone. I talk to a lot of people. They have advisors. Some of them they don't trust, and they don't listen to him or her, and they do what they want, and it's just not a good relationship.
Yeah, and the other thing that people don't realize too is 5% earning in a GIC outside of a registered investment, so we're just speaking non-registered, is not the same as 5% earnings on a dividend or capital gain, right? Because people always forget tax. And I think as Canadians, we know we get heavily taxed. It's killing us. They don't seem to be going down. They seem to be going up. And what you want to do is you want to try to keep as much of that dollar as you possibly can. So if you've maximized your TFSAs and you're putting money into RSPs, for example, where you're just deferring that tax problem down the road, and you're trying to invest some of the money outside of those tax sheltered programs, 5% GIC return, it doesn't net you the same as a 5% dividend or a 5% capital gain average. So those are things that I think people need to recognize and understand. There's also a misconception between what savings is and what is investing. So Ryan, maybe you can speak to that. What's the difference between saving and investing?
Well, I guess savings is something that often people look at as having a savings account, and Denise spoke to it. The bank's very nice to give you a 0.2% or 0.5% on your money. And again, it's a savings account is a safer bet. You're less likely to lose money in the savings account. However, there's trade-offs when it comes to the savings piece. So, you get lower returns. You're usually barely keeping up with inflation, especially right now. You're not keeping up with inflation. So that's really like kind of the basic of what savings is. It's very simple. When it comes to investing, it usually involves investing in some sort of stock or bond or mutual fund, or even real estate for that matter. So usually achieving potentially a higher return over a longer period of time. Again, the rewards are greater when it comes to investing, but also it does come with risks. And again, being able to understand, working with somebody like Denis or ourselves is understanding what your risk tolerance is and what your, the timeline is really when it comes to your money, and whether it's short term or long term. So, and really when it comes to the investing piece, as I said many times before, it's really about, what are your investment risks? We're not simply going to put your money in a savings account. We're going to look at different avenues to create different means of how your money is going to be invested over time. And we've talked about it many times before. I'm sure Denis and Jim can to speak to it too, but I will refocus on being educated about the difference of what your longer term goal is when it comes to investing versus saving. Savings, I guess we would look to as something that's very, very short term, of having some money involved that's easy to access, understanding a few goals that you may have over a longer period of time, say 2 or 3 years or 5 years or 10 years. But really, again, I will cycle back to us as planners and giving that advice of really helping you set out a plan. Educate yourself, have some longer term objectives, have some short term objectives, and how we can find, a clear balance for you, and really make sure that we help you set clear financial goals. And again, for those people, when we're talking about, putting it in the mattresses, sometimes it just starting small is a great start. Even for myself, I've talked about starting small and understanding more about the stock market for myself, but what I'm feeling comfortable. It's like what's the slogan for the lottery system? I can't remember what it's called. Don't push yourself over the limit when it comes to your comfort level. But just being considerate of how both saving and investing can come hand in hand in a great balance, and that finding what's right for you and finding yourself the education will help really propel you when it comes to goal planning. So, yeah.
So to simplify it, savings is for short-term needs, investing is for long-term needs.
Yeah.
That's the bottom line. But what we're finding right now is a lot of people are saving for their long-term needs, and that's going to be a problem. They're just not going to keep up with inflation and some of the changes that are going to be happening in the future. Now, I'm going to share a personal story. It's going to sound a little bit like maybe bank bashing. I'm going to do my best to not name name the villain in this story. I may name the hero. I'll see how this goes because I don't want to get sued. But once upon a time, I believe it was in the early 90s, there was a foreign bank that came into Canada, and they were all of a sudden offering virtual bank accounts. And they had a really good savings account. And they were, definitely the highest in the industry at the time. There wasn't really a lot of competition. I would say the hero in this story would have been Manulife Bank. So this other bank that came in would offer a certain rate, and Manulife Bank and this other bank would kind of go back and forth throughout the year, where one would be slightly better than the other one, and that's how they were trying to compete with each other. And it was a great situation, and people were taking advantage of it. Well, the bank, the foreign bank, eventually got bought out by one of the big five banks. It's the villain, and I'm not going to name the villain. But immediately after they took over ownership of the foreign bank, they dropped the famous rate on the savings account. And I'm not talking like just slightly. Like it was a significant, like I think it was like 75% drop in terms of what they were offering. And then what they started to do was they started to use a strategy. And I know this because a good friend of mine at the time was a senior executive at this said bank. And I remember having lunch with her, and she was livid. And I remember asking her, like, what happened? And she was sharing with me that she just finished a meeting with the senior people of this bank who just took over this other bank. And the reason why they dropped the rate the way they did was they were going to start to introduce these introductory offers or temporary offers, right? So they're going to come in and offer, you open up an account, 3 months, 4 months, you're going to get this fantastic rate. And then it's going to revert back to their current rate, which was below what the actual other institutions were offering. And I remember asking her, I said, well, why are they doing that? I said, well, because they ran their own studies and they found that people who move their money under these offers, 82% of them will just not move again. They will actually just keep that lower rate. They don't want to go through the process of moving that money and moving it somewhere else. So literally they were doing this as a strategy, not for the clients, not for the bank clients. They were doing it for themselves. They were basically fishing people in, hitting them over the head, and then after that they cooked them because they weren't going to move anywhere. At least 82% of them just weren't going to go through that process, right?
Yeah.
That's what they do. That's the game that's played. We've gone through this over the last couple of years with the recent interest rate hikes and inflation and whatever else. And I've had clients come to me say, well, I'm getting this wonderful offer through this other institution, and I'll start running the numbers. And when I look at one of the offerings that we might have where they've been consistently level in terms of the rate of return, they would actually earn more just staying where they are than moving it, getting that temporary offer for 4 months and then reverting back to whatever their rate was, right? So it's just a silly, silly game. I don't like it. I think it's not done for the right reason. People are chasing those returns, not really understanding the impact of that decision. It's just, I don't know if anyone has any other thoughts or comments on that little short rant of mine.
It's so true. The banks and lots of organizations rely on people's inactivity or to just deal with it. And there's many other ones that I could name too.
Because they don't understand, right?
Yeah. And again, for us, we often run the numbers to understand what is the long-term effect of making this move. Again, I remember a few years back, banks were offering iPads. Come on over to us. We'll give you an iPad, right? And that's all it took for a shiny new object to be waved in front of us. This, extra
Thanks
percentage of thing. Exactly, right? So, and then the other thing, in some of them, I saw if you moved your money shortly after the expiry period, they would ding you with a very hefty service fee, right? So administrative fee or whatever magical wording that they could. So again, we ask, and us doing the research too, is what is the balance of making sure you're taking action within your own, again, being educated, and not taking any action. And that's where talking to somebody that is providing actual information, actual education to you to help make a proper decision, then you can make the right one. And again, we're here to help advise along the way and take along the experiences that you guys have had, and for myself, other clients have had. So
Yeah, I mean, the bank employee is not going to go through those details with you. CBC Marketplace recently just did another expose on the banking industry here in Canada, and how they really don't provide proper advice because of some of the pressures that are placed on them from senior level. Denis and I we are former bankers. I don't know about you, Denis, but there have been so many times where I would sit down with a banker as the customer, and I would walk away and I'd think to myself, I can't believe I was on the other side of that desk once upon a time saying those same things, right? Because on the other side of it, I'm walking away thinking, that's just not logical. That just doesn't make sense. And we're not saying all bank employees are horrible. They're not horrible people. They're just trying to do their job. The pressure is usually on a senior level side. But I'm going to use another example here. Again, over the last 2 years, I'd have clients say to me, listen, I'm going to move my money to this other bank because they're going to be offering me this rate of return on my account. Usually I would ask them, send me the offer, let me go through it. And then when you actually read the fine print, it's like you'll never be able to reach that rate of return unless you're giving up your firstborn and whatever else. Like it's, they make it so difficult and challenging. So they bring you in, you move your money, and then you find out, you don't quite qualify for that top tier level because you didn't meet certain criteria. You're only at this level, right? And then people are like, well, I already moved the money, so fair enough. And they kind of move on. So, Denis, I don't know if you have any anger issues towards the banks and some of these practices, but I don't know if you have anything else to add.
Yeah, I'll just add, because it's happened to some of my clients recently with their family members. It's not that their banks are, sometimes we call them bad advised bad people. First of all, they're not trained that well. And they're only trained to talk about what they can sell.
Yeah.
So somebody was asking me, for instance, about they wanted something for to bypass probate, just wanted an investment and wanted to go to the bank. Now, they walked in. So the best thing when you go to a bank is know what you're going to be asking for, or give a scenario and sort of at least have an idea of the answer. So to talk to an advisor, because if they say, no, we can't, and sometimes it just means they can't, but somebody else would be able to. This case, they wanted to bypass probate, and TFSA is not the only answer. It could be segregated funds, but a bank teller or somebody at a bank are not insurance licensed, so they would not be offering that. And it was simple. They said no. My client, family member, believed them and didn't think there was another opportunity. And they walked away. And then, of course, I get asked after the fact, and they're steaming now, but it's a long past. So anytime when you're looking for something, it's best, even if you're going to do a little Google search, do some research, talk to an advisor, especially if you have one, about what you're looking at doing, and at least have an idea of some of the answers you may get. That's the best way to walk into it. And I know there's a lot of talk about title changes and everything else, and who's giving title in Ontario right now. And there's a couple, if you're ever on LinkedIn, there's a couple of guys really slamming the whole process now and how it's like. But anyways, it's a matter of knowing yourself first, or getting the right advice, and then you'll get what you're actually looking for if it's available.
You know what I'm curious about right now, Denis, too, is with this whole Bear Trust reporting requirements now, how are the bankers in the branches, how are the employees actually handling that? Because before, their automatic was, just put your name jointly on, mom and dad's house or their investment account, and that's no longer an easy fix anymore. There are requirements now. I'm just curious on how they're handling that.
And I can answer partially only because I just talked to a client that was given that advice from a bank just recently, and then
just become joint.
Yeah, and actually asked the question back only because we had shared through Instagram and social media about these changes that had happened in December. So I had said, well, I'm glad you watched our video too. So clearly the information hasn't got down to everybody. And I would just add to it's called retail banking because they're trying to sell you specific product for a specific thing, and removing yourself from, like we do, is like, we're not locked down to any, we can work with any bank, any insurance company. It's about what's right for you as the client that comes to us, right? So retail banking, just remember that when you go into any retail store, what's the purpose?
Yeah. And don't forget, the Bear Trust is a fairly new issue. So some of the problems that are going on now, because somebody recommended that you add your name to your mother's account, like it was recommended to me. Mm-hmm. And I said, my mother, she's 88, but she's still with it. She doesn't need my name. I certainly don't want to do any withdrawals. And, there's 2 other kids in the family as well. But, I would have been reporting on that if I would have listened to that advice. I just didn't want to. I didn't feel comfortable at all for a different reason. I didn't know Bear Trusts were coming. But I said, no, there's no need. If there's no need, there's no reason to do it.
Yeah. Well, and the other example too was, I believe it was 2017 when it came to joint ownerships, where it doesn't automatically bypass the estate anymore with joint ownerships of right survivorship. Right there. Yeah. Once upon a time, that's what people were told. Oh, just put your name jointly, rights of survivorship. It'll bypass the estate and it's yours. That changed in 2017. So that's no longer a default. But since 2017, I don't know how many clients I've sat down with who have said to me, oh, the bank said I should just do this, or the credit union said I should just do this and put my name jointly on. And when we kind of dug a little bit deeper, realized you're not protected in that scenario. We need to do a proper estate plan. So again, they are receiving some very bad advice right now.
Yeah, the whole thing came around that they now, because so many people have did it to bypass probate, and then one beneficiary, not the other ones, get it. They just see it now as a resulting trust, so it's automatically your name is only on there, holding it for the estate when the usually elderly parent does pass away. Yeah. So, and that happens in a lot of cases, the resulting trust, and some people don't know that's what's going to happen. Yeah, but that keeps the courts active with, or less active with other people not suing each other because they wanted a piece of that bank account as well, or the stock account, or the house, anything like that. And there's a lot of court cases regarding that when they don't agree. But it ends up in the end, you are only holding it in trust, and that's why you've got the Bear Trust. And you're not really taking ownership because you didn't put any money into it. You're not paying the bills. There's no reason you should have it. It's going into the estate.
You're the favorite in the family.
Yeah, but it causes other problems too, right? Because if you put your name jointly on your mom and dad's investment account or home, even while they're alive, if there's a marriage breakdown, that becomes part of the matrimonial assets. Yeah, they have a right to those assets under those circumstances. If you become bankrupt and you're going through bankruptcy, those are assets that the creditors can go after. Yeah. If you're being sued, same thing, right? So, and I know that I'm sorry, but the teller or the advisor at the bank, because we were never taught these things when I was working there, they would never sit there and say, hey, these are other potential risks associated with you adding your name. They just say, just put your name on it. You're protected. Well, they're not. So I think this is a good opportunity for me to say, if you have your name jointly on, a mom or dad's account, or even a sibling potentially, right? Or if you're a parent and you have your kids on jointly, you might want to just kind of reevaluate your situation to make sure that you are protected from the things that you were hoping to protect yourself from. Is that fair? Say that? Mm-hmm. All right. Yeah. Yeah. Okay. Rant over. Let's move on and talk about, for the people that are sitting on the sidelines right now that are nervous in getting it, because I think there's also a misconception where people think it's all or nothing. All the money should be sitting in my savings account, earning whatever, or I have to fully invest the money so I don't miss out on the upside. That's not true, Denis, right? I mean, one of the things that I'm a fan of is dollar cost averaging. So they don't necessarily have to take their lump sum out of their savings account and put it in a portfolio or an investment. they can do it slowly over time. So can you
Yeah.
maybe talk about the benefits of dollar cost averaging?
Well, that's when you're not timing the market and you're putting money in a little bit all the time. Where it's an up market, you're buying, you're paying a little more. But if it's a down market or the big swings, some months, because it's usually monthly, some months you may buy at a lower price, some months you buy at a higher price. But like dollar cost averaging, it will average out. Now, the one thing about holding cash in a portfolio, cash does have a place in a portfolio. So it's easy, especially if you're going to use some of that money sooner rather than later. Cash does have a place in a portfolio. And the only time I recommend cash, and when I have conversations, is that sometimes some people just don't belong in the market. If you're looking at your values every day and if they're going down and you just can't sleep at night and, you get it stresses you, then cash is the place for you. And I don't think you should be coming back either, because you are going to get the swings in the market. They usually the swings are on an uptrend, as we see. That's why the markets outperform cash in the long term. But if you're going to have trouble and look at it every day, and that's going to become your sole source of stress, then I would not recommend you investing. But like I said, cash does have a position in the portfolio, and there's nothing wrong with it. Right now, some of the people that were getting low interest rates at the bank, like the 0.25, 0.5, we're adding it to their portfolio, but we're keeping it in cash in a cash ETF where it's getting over 4%, and it doesn't necessarily have to be invested after in stocks and bonds in the full portfolio. It can remain as part of the portfolio, and you have to look at everything as a whole, not just one piece of it. And that seems to go well with clients. A lot of clients have taken some of their money out of the bank, put it in their portfolio, left it with their longer term investments. In time, some of it may come into the longer term investments, but if not, it's going to stay in cash, earning a better yield, definitely a better return than would have been sitting at the bank account and getting that rate, like I said, over 4%. Than just sitting there doing nothing. Because sit there doing nothing, sometimes you stop looking. You don't look at your bank account all the time. You tend to look a little more at the investment account, and it is a good strategy for a lot of people. And it suits a lot of people. Not for everybody, but it does suit a lot of people.
Yeah, and I mean the risk in sitting in a daily interest savings account is the fact that, again, it doesn't keep up with inflation. It won't potentially allow you to really achieve some of those long-term retirement goals, as an example. Obviously, the positive side, I know people are going to comment on this, so I'm just going to say it right now. There's no chance of you losing that money either. So we will say that, yeah, there's no market fluctuation, but you are long-term, if that's your strategy, you are losing purchasing power. That's just a fact. So there needs to be consideration there. For people who are putting their money into GICs and they're locking them in for 3 to 5 years, I will share with you, based on past experience, that you might sit in a 5-year GIC earning 4.5% for the next 5 years, feel good about it. When the markets start to rebound and the markets are now averaging 7, 8%, whatever that might be, you're going to be upset that you're only getting 4.5%, 5%. And the other part too, with the GIC, is your money's locked up. So if an opportunity becomes available, if you need access to that capital, you can't close it out unless you're going through bankruptcy or death. And even on death, and I used to work near the estate department in one of the financial institutions, I have seen estates take 12 months to 24 months to settle because GICs were held.
Yeah,
And that
I've seen
causes
that.
other issues as well.
Yeah, I've definitely seen that a lot with clients where they're sitting, waiting for a death of somebody, and it's locked in for almost 2 years before everything gets settled. And it can be troublesome to both move on and at the same time just get something off your plate. So there's a real struggle for people, and people don't think about when was the last time your roof went, or you had a flood in your basement and you suddenly need an injection of $5,000 to clean that up. Well, it's locked up in a GIC. You can't do anything. Then, there's a side that we're taking out money from somewhere else, potentially our RSP, which as somebody very wise helped me understand even further, which was it's a joint account with the government. RSP is a joint account with the government. It's one of the best things, and people forget that when it comes to RSP. So,
And it's not just on, if there's an emergency, but also you can miss out on opportunity.
yep.
There could be opportunities. I know in the past when I'd work with clients and I'd ask them if they were looking at potentially owning rental properties. And they would say, absolutely, that's a goal, just not ready now, but maybe 6 months from now, maybe a year, maybe 2 years from now, depending on what the real estate market does. I'd say to them, then don't lock in your money into a GIC, because if that opportunity becomes available, you're going to miss out on that opportunity because your money's tied up. So the one thing that we have been doing over the last 2 years with the current interest rate environment, for people who just keep insisting that it has to be GIC, they want zero market risk, at the very least, we've been recommending cashable GICs, because one of the things that wealthy people value is having use and control of their own money. They don't like their money tied up. They want to have access to it because they don't want to miss it on opportunity. So at the very least, we've been placing people in cashable GICs just in case. And from an estate point of view, they're cashable. You're not waiting 2 years for the GIC to mature. You're getting that money within 5 to 10 business days after the claim has been approved.
Mm-hmm. Yeah, I think
Right.
something that often happens with people in their understanding and fear of the investing piece instead of holding in cash is really, again, their fear of losing money. We've talked a lot about that right now. And really that comes down to education and understanding. I think, Denis talked about, timing the market and that fear. I've seen a lot of the things where people are scared because the complexities that often happen when it comes to the investing and how complex they think it can be. But again, with a good team around you, those complexities kind of go to the wayside along with some education. And I think something that's changed a lot with the banks that I've seen over the last few years is what people need to start with. What is the minimum amount that they need to start? And a lot of banks have increased the minimum amounts that they need to start. So people are discouraged by that. Some banks are using $1 million as their minimum investment marker, and people just simply don't have that. So again, overcoming those fears is helped by talking to the right people like ourselves to help kind of take away some of those misconceptions out there in the market.
I think I want to talk about the fear of losing money. And Denny, maybe you can help me with this one too, because when I meet with a client and I ask them about, what to define risk, what's their main concern? And their concern is, I don't want to lose my money. And if you're in a single stock, you're definitely at a higher risk of losing your money or again, having a windfall, and that's casino gambling for me. But Denis, tell me if I'm wrong here. If a person is in a well-managed, well-diversified portfolio, like we have at TVH Wealth, 12 different asset classes, there's really two ways that a client theoretically can lose all their money, right? Or lose money. I guess the first way is if they decide to cash out when the value of the portfolio is down, it's in negative territory, right? So there would be some partial loss, and that could be 5%, it could be 10%, depending on the condition, right? Mm-hmm. The second way that theoretically they can lose all of their money is for every single stock, financial security, mortgage that's held, real estate asset that's held in the portfolio, every single one of them would have to go down to a value of 0 in order for someone to lose all their money. Is that fair for me to say?
Yes. It's almost impossible because especially in the portfolio like at TVH Wealth, there is big diversification among asset classes, as you mentioned. And that's key to minimizing risk. And some of the managers we select they certainly go down less than the market. They're not all correlated. So if the market goes up 5%, they're not all up for 5%. They're not exactly 100% correlated. So that's what you want. You want something that is diversified enough to minimize risk, but at the same time, give you some gains. Now, when it comes to risk and lose all their money, if I have a conversation like that, there are portfolios that will have less risk than others. We have a growth portfolio, and all the way down, we have a preservation portfolio. So anybody that's talking that they maybe only want to see those 2 to 5% returns, and they'd be happy, or higher, obviously, depending where the inflation is, then we would start talking preservation, especially if it's shorter term, and they may be taking out money because they're retired now and they're starting to withdraw. So that would be preservation. Other people that they have a longer term horizon and they're not going to be withdrawing, we would go with of course, the growth fund. There's a little more risk, but they have the longer term where you could see the ups and downs. Some years you may have losses, as we've seen in the last 5, but some years you can do very well. So that washes itself out, the ups and downs, and then you get the steady return, the slow but steady return on the way up. So
when you're talking about risk, though, it's volatility risk, not risk of losing all of their money. I mean, I guess we can say, is it possible that they can lose all their money where, again, everything in the portfolio is going to be valued at 0? Sure, it's possible, but is it probable? Absolutely not.
No. And that part, it's. I was talking more of a percentage, how much you want to potentially lose.
Up or down, yeah.
Yeah, it's more the volatility on the returns, but losing everything, no.
Yeah.
And you don't come to us because there's a potential that you may lose everything. No, we're not. All 3 of us, we know we're going to invest in something that's not going to be that volatile. It's not a one of the cryptocurrencies. Bitcoin's been up, and look how much it's been down as well. So that where you could lose a good portion. I know some people were talking the last highs that they want to put all the money in before it went all the way back down again. That's a lot volatile, and that's a different scenario. I wouldn't call that investing so much anymore. The way the cryptocurrency move. Investing is actually in growth, where it's actual companies that are growing their businesses and creating earnings.
Yeah,
not something that's not having earnings.
Yeah, just a reminder for people: the TVH back there, that's tortoise versus hare. We're the slow and steady. That's our approach. And where I know I've struggled throughout the years is when the markets are hot and they're on fire, and people are getting double-digit returns elsewhere. They're not listening to me because I'm not giving them that type of return based on how our investments are structured, right? Where we tend to do well is when things go really bad for people, right? And all of a sudden they're coming back saying, oh, you know what? We like that consistency. We don't want the roller coaster ride. And I think where people have kind of got caught with a little bit of that was with the whole robo-advisor platform. They talk about saving that 2% fee and don't have to pay the fee. And theoretically, you should have that money's back in your pocket as long as you stay, invested over 30 years. The problem where that fails is behavior. And people don't react. So there's the investment return and there's the investor return. They're right. If they put their money all in ETFs and follow the indexes and let it ride for 30 years and they don't pay a management fee, they're probably going to do fine. The reality of it is those robo-advisor platforms are not coaching people when the markets are down 15, 20% and there's scary things happening. And, Jay, who's part of Raintree Wealth Management, would say things like, you get punched in the face all of a sudden. There's no one talking them through those situations and coaching them. That's what you pay. That's part of why you pay a management fee, is because you have someone who's coaching you so you don't make bad decisions. And that's the reality.
Yeah, and just to add to that, when I see those commercials that they're going to automatically saving 2% or 1.5%, well, that's if you're investing in the exact same portfolio. You're not investing in the exact same portfolio. That line or theory, whatever you want to call it, of you're saving all this money only works when you're investing in the exact same portfolio where one you're paying the 2%, the other one you're paying 0.25, we'll say, whatever they're paying now. Otherwise, that theory just falls apart because you're going to be invested very differently when you're paying a management fee because you're paying for that and not an ETF. That's just get a couple questions. Here's your portfolio, and is it going to change? Not likely.
No, you're right. Well, gentlemen, we're approaching the 50-minute mark here. So once again, we've kind of gotten into conversation, and it's been wonderful. But I think we need to wrap things up. So final thoughts, Denis, before we shut her down.
Going back to the cash part, I would say cash can have a position in your portfolio, but just to hoard cash and only cash, that doesn't work.
Great. Ryan?
Right.
For me, I think just understanding what your motivation is around keeping it in your mattresses, working with an advisor to help set actual goals, both long-term and short-term, and really educate yourself, and start small. If you're really unsure, start small with a trusted advisor. So,
and not just set those goals, but also make sure that you're on track with those goals, right? I think that's the other thing too, is people will go ahead and set the goal, they put the plan in place, and then they kind of like forget about it, right?
Yeah.
What's as important is making sure that you're on target, you're on track. Do we have to make adjustments? So that's very important as well. So I want to thank you guys for joining me again today. Finally, just educate yourself. You don't have to necessarily speak with us if you don't want to. If you have a trusted advisor, speak with your trusted advisor. If you are looking for a second opinion, we would love to speak with you. So you can find us at tvhgroup.ca, tvhfinancial.ca. Denis can be found at tvhwealth.ca. You can also email us financial@tvhgroup.ca or call us directly at 647-727-4668. And finally, look us up, Facebook, YouTube, podcast, Twitter, Instagram, all of the social media platforms. We're pretty much on there. All right, guys, have yourselves a good evening. And until the next time, we will talk.
Why is it